Welcome to a very special commemorative edition of Making Sense, where we're going to observe the 20th anniversary of quantitative easing. Yes, ladies and gentlemen, 2 decades ago this week, it was first released from its academic cage, that monetary experiment. It was loosed on the world, and it's been roaming the planet ever since. And we're going to track it down. It was last reported in that wonderful, magical land of New Zealand, everyone's favorite country, a land of mystical animals like the platypus, the narwhal, orcs and elves, and quantitative easing. And our tracker is going to be the renowned head of global research, Jeff Snider. Welcome. Did I even mention Alhambra Investments? The head of global research for Alhambra Investments, Jeff Snider. Jeff, very exciting. This week is full of anniversaries. Jerome Powell. Yeah, go on.
I'm not sure I would say excited, and I'm glad you didn't use the word celebrate as far as the anniversary. It's sort of like the 20th, marking 20 years since a cancer or virus was let loose upon the world. And that's really what quantitative easing has been. It's been an experiment, but more like Frankenstein's monster than any kind of, wonder drug or palliative cure. It's been, and the thing is, as you pointed out, it's gotten to the point where it's everywhere. Even New Zealand cannot escape the ravages of quantitative easing. And the reason why it's such a, at least in our estimation, a negative factor or a negative event is simply because it not that it destroys on its own, but it prevents the world and people around the world from understanding what's really going wrong and then finding a solution. So it's basically this enormous time waster, which is why we're quote unquote celebrating, or at least acknowledging 20 years have been squandered under a program that its own designers and cheerleaders say doesn't really work.
Well, what do they tell us? What is it supposed to do? What is any large-scale asset program supposed to do? And then we'll talk about what actually happens.
Yeah, what it's supposed to do, there's 3 major effects, and we've talked about this before. The first is portfolio effects, which is they buy bonds from banks, and the banks are supposed to go out and buy risky assets with it, including lending. They're supposed to lend. If I buy a government bond from you, go out and lend. We're not going to focus on that one so much. The second channel is, we'll talk about quite a bit, signaling, which is, hey, I'm a central bank. You think I print money. I'm doing something. Therefore, you believe I've just printed money. That's accommodative. It makes you happy. You start spending and hiring and investing, and all these good positive economic virtues take place. And the third channel is probably the easiest, most intuitive to understand, and therefore what's probably the least controversial in the mainstream estimation, but probably should be the most controversial because it sort of disproves the entire thesis, is that it lowers interest rates. And that makes sense too. I mean, look, central bank is buying bonds, bidding up their price goes up, interest rates go down. Lower interest rates means it's cheaper to borrow, therefore accommodative. I mean, it all sounds so perfect, neat, simple, tidy package. How could it possibly be wrong?
That's right. That's what the Reserve Bank of New Zealand said when explaining what a large-scale asset purchase program is. And it said, quote, "This has the effect of lowering the tide on other interest rates in the economy, particularly longer-term interest rates, or 2 years or more. It also reduces the cost of borrowing for households and businesses." And they say that it underpins economic growth and inflation. And they also give an explanation of what an estimate is, of what that impact is. But before we get to what the estimated impact of QE is on long-term interest rates, Jeff, why are we talking about New Zealand? It's a beautiful place. It's as if like Norway and Iceland had a baby. That New Zealand is the result. It's got these fjords. It's an island. Amazing. Everyone loves it. So why are we? But no one, we don't think of the New Zealand as being the hub of monetary excitement. Why is New Zealand in the news?
Well, for people who pay attention to these things, the sad, lonely people like myself, New Zealand had a sort of busted QE program or QE operation earlier this week, which was they wanted to buy 120 million New Zealand dollars worth of government bonds. I believe they got submitted bids of only 92, of which 50 some odd were accepted. So less than half the bonds they intended to buy from the banking system on the islands were actually sold by the banks because the banks preferred to hold on to the bonds rather than sell them to the central bank. And the reason was because, as we see quite often during these QE programs, interest rates were not rising, interest rates were falling. In fact, they fell sharply during this busted QE period over the last couple of weeks. So here we have banks buying and holding on to bonds again, and not, in this case, not wishing to sell them to the central bank, leading to a shortfall in their program.
Is that unusual? Has that happened before in the advanced economy world, these kind of busted QEs?
It is unusual, it's highly unusual, but it has happened. So it's not something that's earth-shattering or completely unprecedented, but it's another key indication of what's really going on with these QE programs. Buying bonds, lowering interest rates, stimulating the economy. Is that really what happens here? And when you start looking down that road and they start examining down the rabbit hole of what actually happens during quantitative easing, not just in New Zealand, but everywhere it's practiced, what you find is, wait a minute, interest rates are already usually falling in a longer term or intermediate term sense. And so here comes the central bank coming in after rates are falling, saying, well, we made rates fall a little bit more.
Well, I'm going to reference New Zealand's conclusion, or at least their explanation of what studies have found. Studies found the government bond purchases, so QE, worth 10% of GDP have, on average, lowered the 10-year government bond yield by around 50 basis points. And in this article here that I'm referencing, the article is called Kiwi Busted QE and its relation to the reflation story. And it was posted at Alhambra Investments on March 24th, 2021. And Jeff, I'm no expert at this, but as I was reading that, I was thinking, I don't know, that seems like a lot of effort, 10% of GDP and 50 basis points. And that's exactly the point you made right after that quote is, where's the
really
beef?
Underwhelming, isn't it? I mean, 10% of a QE or LSAP that's 10% of GDP is enormous. In the United States, we're talking multi-trillion. Mm-hmm. That's what 10% of GDP. And the result of that is you lower interest rates by 50 basis points, 0.5% for 10% of GDP. I mean, it's entirely, completely underwhelming. And it's even arguable that it's 50 basis points is attributable to QE. But even, let's assume that it is. Go back to look at the U.S. Treasury yield history over the last decade, or 12 years since QE was implemented. Interest rates have fallen by a lot more than 0.5%. So if we're saying that $2 trillion in QE gave us 50 basis points of 3 and 3.5% since rates have fallen since going back to 2007, that means the market dropped interest rates by a ton more than central bank buying ever even thought of. And so, again, we're getting back to the question, what is it that QE actually does? And if you go into the literature, even to the beginnings, the origins of QE, it's not at all what you think. It's not what it's supposed to be. And in fact, when you review the literature and you review the transcripts and the discussions about quantitative easing, what you see is this thing is just kind of a made-up smoke and mirrors. Let's just call it something and hope that people buy it.
Let's go back in time. So the busted QE that we just auctioned that we saw in New Zealand was the Reserve Bank saying, here, take our cash, and the private banking system saying, no, we don't want your cash. That's very unusual. We want the collateral. Well, if we go back 20 years, we hear that again about the cash, the money printing. Here's a quote that you pulled from CNN on QE's very first day 20 years ago. And here's how they explained it. The Bank of Japan's move injects a large amount of money into the Japanese economy. Great. Known as quantitative easing. And then you say the media still writes the same thing. Darn. Oh boy. All right, ladies and gentlemen, that was a fire alarm that went off. I don't know who's trying to keep us off the air, but they're not going to be able to do it. We're going to give you the truth. Here it is. No fire alarm is going to stop us. So CNN, 20 years ago, it was money printing, they said. Here it is. the Bank of Japan's move injects a large amount of money into the Japanese economy, known as quantitative easing. Well, the media still says that. They still say it's a large amount of money. And who turned down money?
Injected into the economy, right? I mean, I think that's the key word. And it's you know, as I said, I think both parts of that phrasing is wrong. It's not money, it's bank reserves. And the second part, maybe more important, is does it actually get into the economy? When you go back to the early days of QE, what the Bank of Japan was debating when trying to come up with what would quantitative easing look like, they had the same sort of discussion, which was, is it really money, and are we injected it into the real economy? Because that's really the point here. That's what Milton Friedman said. I think we talked about this a long time ago, you and I, Emil, where he said Milton Friedman came up with the idea for quantitative easing when he said central banks should be buying bonds, creating reserves, which he called high-powered money. Therefore, high-powered money gets into the real economy. Yet the Japanese, after their experience of the lost decade, were saying, there's something else going on here. First of all, we know bank reserves themselves may not necessarily be money because for the last 20 some odd years, we've had a lot of trouble figuring out what money actually is. And because of the lost decade in Japan, because it had this, this plague of zombie banks, quote unquote, during that period, as I think it was Eiko Shinsotsoka had said, and when she voted against quantitative easing that first time around. She said, look, why are we doing quantity of money since we don't do quantity of money anymore? The relationship between monetary statistics and real economic variables, as Alan Greenspan had pointed out throughout the 90s, had broken down a very long time before. So why would the Bank of Japan, knowing full well that quantity theory doesn't work, why are we going back to quantity theory? In fact, she based her dissent against quantitative easing in March of 2001 on that fact, that they had not enough discussion about the idea that here we're going back into a quantitative target when for a long time before then it had become settled policy proposition that you don't do quantity of money because you can't.
That's right. Eiko Shinsotsoka. I'm sorry, I'm mispronouncing it, but she voted against it, as you tell us here. And there were 9 board members, right? And 8 voted for it, and she stood alone, and she said no. And did she also vote against zero interest rate policy a couple years earlier, Jeff? Is that right?
Yeah, she was a well-known dissenter for various reasons. And I actually wanted to talk a little bit more about her in the article. Didn't have a chance, and how she and Richard Fisher of the Dallas Fed were actually very similar in their outlooks and their viewpoints, and how it was interesting how she came to object to QE in sort of the same way that Richard Fisher had many years later in the United States, saying, why are we buying bonds the market is already buying? And it's funny how they come at that from a very different position, sort of being lone dissenters, and end up arriving at the truth almost by accident. And so for Eiko Shinsotsoka, what she was saying is, why are we doing this? Because we've said for years we can't. Why are we even thinking about doing this? And we're not discussing enough about this quantitative theory of money that has, in central banking regimes throughout the world, been completely, totally upended for many, many years.
Well, Jeff, I encourage you to write about it next week. I'd love to learn more about her. When I was reading this, tell me if I have this right. I believe it was Sheila Blair in the United States in the early 2000s, late 90s, that was going against the tide, against Greenspan, against Larry Summers and Robert Rubin, who wanted to loosen up the regulations. And she made some points and she was moved aside and ignored. And I think in retrospect, it would have been better to listen to some of her points, like we have here in Japan. Did I get that name right? Was it Sheila Blair?
Sheila Blair, yeah, and she was, in a lot of different ways. That's how central banking monetary policy isn't a scientific process that it's made out to be. In fact, most of the time, it's somebody has an idea, they draw it up on the blackboard, spit it out in DSG models and Monte Carlo simulations, and then it becomes a matter of groupthink. Everybody believes it because everybody believes it, and nobody's allowed to challenge what becomes settled orthodoxy. And so even before quantitative easing was a thing, it had become a settled orthodoxy that, look, central banks need to be accommodative. But we need to be clear, even after 20 years, of how is it that central banks claim they're being accommodative. It's not by printing money. As Eiko Shinsotsoka said, we don't do that. quantitative theory doesn't work because we can't define money, and we're not even talking about that fact. So getting back to the CNN quote, it's not money that they're injecting in the economy because they don't know what money is. It's basically an accounting fiction of bank reserves. And so then the other question is, how, if it was, how does it get into the real economy? Assuming bank reserves are money and useful and effective in any sort of way, how are they supposed to get from the central bank into the real economy? And the answer always is the banking system. And so what she said, and others joined her in questioning this during their first debate, what they all said, what they all realized was that, look, if the banking system is not pliable in the way we hope it is, this is just all academic nonsense.
And a good example of that is the amount they picked for their first quantitative easing. Tell us about what amount it is and how it speaks to the unscientific guessing nature of this program, this experiment.
Yeah, look, they said we're going to do $1 trillion. We're going to target, the quantitative target of the first quantitative easing was to raise the level of bank reserves in the Japanese system from 4 trillion yen to 5 trillion. So it was an even 1 trillion. When you look at that and think, well, is that really precision? Is that really science? If you plug in a number, and if you plug in, a bunch of variables in a formula, is it going to spit out a round number like that? Or are they just kind of plucking a round number out of thin air and just saying, well, that's probably good enough? It cuts against the entire idea of quantitative easing being quantitative in the scientific sense. You would think that if they were going to be quantitative about it, it would have been, 1.2187632 trillion instead of an even number. But that's, again, quantitative easing throughout its 20 years, its 2 decades, it's always been like that. It's always a round number because there's nothing scientific about it. They're just pulling numbers out of thin air in trying to identify what are big enough numbers that it can influence expectations.
Exactly. We're going to talk about expectations, that was the real purpose behind QE and always has been. But let me just give a couple of numbers to the audience. So total reserves had been approximately 4.4 trillion in February of 2001. By the middle of 2004, that had expanded to 27.5 trillion. Did I say trillion the first time? 4.4 trillion to 27.5 trillion in the middle of 2004. And here is the damning part, and it echoes what we were discussing not too long ago with the 1930s in America. Total bank lending during those years dropped by more than 10% regardless. If you have any comment on that, let's talk about it. If not, we can move on to the expectations, the emotional, the forward guidance, the moral suasion. That's the real purpose of this quantitative easing.
Before we get to that, though, I think I want to go back and highlight and really go over that point, which was that even back in March of 2001, when they're talking about quantitative easing, the policymakers in Japan knew that the sticking point was the banking system. So if we're going back to our original CNN formulation, money gets into the real economy, it has to go through banks to get there, right? And so if the banking system says, I don't care how many bank reserves you give us, we're not going to lend, we're not going to create credit, then it doesn't matter, right? That's the whole point. And in fact, they knew that going in. One of the quotes I pulled from the minutes of the March 2001 meeting of the Bank of Japan meeting, it said, many members pointed out that the effectiveness of monetary policy was being undermined by the fact that the credit creating function of financial institutions was not operating sufficiently. And as the statistics you just pointed to, Emil, show, it didn't matter if they did quantitative easing or not. They did, 20-some trillion in bank reserves in a relatively short period of time, just a couple of years, and lending fell by another 10%. While at the same time, Japanese government bond yields were basically steady at very, very low rates. So there was enormous demand, even though the fiscal authorities in Japan were issuing debt. Enormous demand for safe liquid instruments, no demand for lending, even though the Bank of Japan undertook massive quantitative easing, or at least what they said was massive quantitative easing. So there's nothing monetary, and it doesn't get into the real economy. Yet 20 years later, that's how it's always talked about. Money printing that gets poured into the real economy.
Now, Jeff, here you say that they were concerned about non-performing loans and that those had to be fixed. But then you say it wasn't non-performing loans after all. Let me ask you a question, a little bit of a detour off our script here. At that almost exact same time in China, right across the street, they had a similar idea, similar program. They had tremendous non-performing loans. It was estimated that perhaps up to 40% of the bank's books were non-performing. And so they took those, they tried to. In the first couple of years, it wasn't so successful. They took those non-performing loans and wanted to put them into 4 asset management companies. And seemingly that was successful eventually, while in Japan it wasn't. I'm wondering, Jeff, was it really successful because of what China was doing, that they had a different policy, different idea than what Japan did? Or was it the fact that the Eurodollar system took off and money began to pour into China, but not Japan? And that washed away some of the problems. I'm just guessing. What do you think?
No, I think you have it exactly right. In fact, Japan played a central role in all of that, especially as Japanese banks decided they wanted to get into the Eurodollar business, getting more involved in the Eurodollar business as well. So they were busy diverting dollars into China at the same time they were looking at the Japanese economy and their own Japanese loan books and saying, we don't want to participate in it no matter what the Bank of Japan does. Because we live in the Eurodollars world, it doesn't matter what central banks do. It only matters what banks do in the Eurodollar system. So in terms of what would happen in Japan, it wasn't an NPL problem. It was an unstable yen problem. The fact that the yen was no longer viewed in this, at least in the same way as it had before the 1990 collapse, and therefore the banking system said we're just not going to participate in yen finance, except for borrowing and buying and collateralizing the safest, most liquid yen instruments, these JGBs.
Let's talk about what the, I don't want to say real because that sounds conspiratorial, but the more, I don't know, how would you put it, Jeff? What was the reason that they were doing quantitative easing in Japan? They wanted to show
the true intent.
The true intent was to show.
It's really the signaling expectations channel, which is that, look, we don't do money because we can't, which is what Eiko Shinsotsoka was pointing out. We don't actually do that, so what do we do? Well, we get people to believe we do. They look and they say, well, that central bank is doing something, therefore it must be accommodative and helpful or whatever. And what central banks had done up until that point was whenever they wanted to be accommodative, whenever they wanted to signal easing, they would lower a short-term money rate. They would reduce their interest rate target. But Japan had done that all the way down to the zero lower bound by the end of the 1990s. So what they realized is that we can't cut rates anymore. We can't do something, at least not the same thing, not the same something that we have done before. So they had to do something else to show people they're doing something, and that was to buy bonds. But the problem, another part of the discussion was that they already bought bonds. And so they couldn't just buy government bonds and say, well, we're buying more government bonds, because that wouldn't be a powerful enough signal. So they said, in order to make this a powerful signal to get out of this deflationary trap we can't seem to get out of, we need to do something big and awesome and radical. And that was to target a level of bank reserves, as we said, and to target a big enough level of bank reserves that it would signal to the Japanese public, to Japanese businesses, that the central bank wasn't out of accommodating businesses. It was, in fact, going beyond all sorts of prior established or traditional boundaries, money printing in popular imagination in order to accommodate, ease, whatever you want to call it.
And now that same belief is in New Zealand, is that right? You know, they want to show that they're doing something, but the banking system's not really buying it. They're saying, we're going to hold on to this collateral because things seem to be turning the wrong way. Jeff, is there anything that we haven't covered from your Real Clear Markets essay, by the way? That's what it was posted today on the 26th of March. It's called Central Banks Do Not Do Quantities of Money Because They Can't. Is there anything that we didn't cover in this essay?
Yeah, I think I want to point out one more thing and yet, emphasize yet again is that central banks don't believe this works either. And that's really the point here, is that 20 years of this and quantitative easing is everywhere. And you think, well, it must be everywhere because it works really well, right? I mean, that's why everybody else has adopted it. But if you really realize what was going on in March 2001 with the Bank of Japan discussion, the reason they adopted quantitative easing is they didn't have anything else they could come up with. They were so desperate, they decided, well, we need to signal to the public, let's just pretend we're money printing and hope everybody just follows along. That's honestly what they actually decided to do. They had no other ideas except to try this one thing, which wasn't money printing. It doesn't get into the real economy without the banking system, but yet they had no other options. And so I think there's this popular imagination that quantitative easing is money printing, it is economy, and it is very successful. But yet when you go back and you look at 20 years of scholarship, academic research, central bank reviews, they are unequivocal. The best that they can say about quantitative easing, as we said earlier with New Zealand's view, is that maybe it lowered interest rates by a little bit more than the market had already lowered interest rates. If that's the best that you can say about quantitative easing, it doesn't work. And I want to highlight a quote I pulled from one such study. I mean, there's dozens of these. This one was from the IMF back in 2012. Research on the effectiveness of earlier quantitative easing has yielded mixed results, to put it most kindly, with most pointing to limited effects on economic activity. While most papers found evidence that quantitative easing helped reduce yields, as we said, a little bit, its effect on economic activity and inflation was found to be small. Here's the money quote. The reasons cited included a dysfunctional banking sector. So the most that we can ever say about QE is that it helps reduce yields, which is weird because, as we note all over the place, and whenever quantitative easing is actually implemented, yields are already falling, and they fall by a substantially larger amount because of what the market is doing than what central banks are doing. So you have to ask, I mean, if interest rates are already falling because things are bad enough to begin with, how does it become good that the central bank might make rates fall a little bit lower than they already were? It doesn't just it's not just illogical. It doesn't even make sense in its own way.
Yeah, powerful, damning, heartbreaking. I don't know how to end it, Jeff. I hope that somebody one day
I think
in charge.
the reason why quantitative easing has proliferated in the way inflation obviously hasn't, and economic recoveries obviously haven't, is because they know economic recoveries haven't come about, and they don't have anything else. Their only other option, and I'm talking about central bank and monetary authorities, their only other option is to admit the truth, which is what Eiko Shinsotsoka had said 20 years ago. We don't do money. And so it's an option of keeping up the pretense, keeping up the smoke and mirrors and the CNN articles talking about trillions pouring into real economy, in the hopes that one of these days maybe it will just magically work. Because after 20 years, the research, the academic, the evidence, all of it has shown conclusively it doesn't.
The ongoing labor struggles will hopefully inspire the people in democracies to force their politicians to hold central bankers to account. That's what I've been keeping my hopes on, but it's been a number of years. Jeff, powerful stuff. Thank you.